All right, welcome in everyone. Thanks for being here tonight. What is this? Our third AI Circle of the year, first one for February on the shortened month. So thank you for spending some time with us tonight. It'll be the pretty much normal agenda and all that. But we all know why everyone's here. Let's welcome our friend Kelly Korshak in. Kelly, how are you?
I'm hanging in there,
Yeah,
Lee. It's,
that
it's
you
still a
are.
new year, but we're now into February, so I can no longer say Happy New Year.
Yeah, it's I saw something on the radio like middle of January. They're like, how late is it to say basically like when can you not say Happy New Year anymore? I think we've kind of passed it.
It's over.
So awesome. Well, everyone, if you just say hello in the chat and thank Kelly for being on here. He's going through a lot and he's not feeling very good either, but he did want to share his thoughts with you guys tonight, and we all appreciate it. So thank you, Kelly.
My pleasure, actually.
So I'll just bring this up, and as always, we'll get your screen sharing soon. But for anyone joining us for the first time tonight, here's our little agenda that we'll go through. So first, probably 10 or 15 minutes or so, Kelly's going to talk about the market, give his update. If you were with us last time, we had made a ton of trades in the last week or so at towards the end of January. Not as many to go over this week, but there are still some. And then Q&A will be pretty much throughout the show. Feel free to put your questions in as they've come up. Don't feel like you have to hold them to the end, but we will answer those in the second half of this. And then the Q&A is actually your gateway into getting potentially an Amazon gift card. So we'll go over all of that towards the middle. But first, Kelly, before I can let you share screen, I do have to go over our fun little disclaimer here. So iFlip Investor Inc. and iFlip Financial Services are not financial advisors and do not make, buy, sell, or hold recommendations on any financial instrument. This presentation is for educational purposes only. Unique experiences and past performances do not guarantee future results. All financial investments involve risks. You should speak with your CPA or financial representative to ensure the iFlip smart folios that you are selecting are suitable for your investment profile before trading in a live brokerage account. So, Kelly, with all that fun stuff being said, you want to get into the sharing screen and doing your thing?
All right, yes, let's do it. I think everybody should be able to see the screen.
Yep.
We're going to follow our normal format. We'll go over the indices, and then we'll go over currencies, interest rates, crypto, just the Bitcoin.
Yeah. Actually, let me step in just because I get the question about every day. Have you heard any new news about the BlackRock Bitcoin ETF? Any
Well,
recent developments?
nothing really recent except that it is, as we did establish last time, the symbol for it will be the IBIT.
Oh,
That
okay.
one was established literally just a couple of days prior to the last AI Circle 2 weeks ago.
Got it.
The product is going to be launched. It's just a matter of time. And that's why there's a bid underneath the cryptocurrency, and it keeps it in the 40,000 area just off its recent highs of 50,000.
Got
Already
it.
got through it, but nothing else new there that I saw that was meaningful. There's always a little bit of information every day, though.
Sure.
All right, let's get to it. Well, all right. 2 weeks ago, and 2 weeks more go by, and we are up, just call it another 3% on the Dow Jones. We continued to advance in both the Dow Jones, the S&P 500, up just a little less than 3%. And of course, the NASDAQ up even a little less than that. So it's really been the Dow that's rallied the most over the last 2 weeks. The S&P, the major index we follow, there's a picture of it. And if we go to the last AI circle, we will see that, again, the market is up just under 3% on that. That's what really matters. So we had a good January. The last day of January did take something away. But all in all, January was an up month. And generally, January up means the year will be up. But if you remember, last year, January was also up, but we didn't make a new high above the January high until November of last year. So in this last year's case, it pulled a rabbit out of the hat by advancing this huge amount. As you can see, at the end of October, this is the end of October, at the beginning of November, the market just exploded higher. All of a sudden, all the information changed literally in 2 months. Everything that was digested all of 23 was completely overturned in the last 2 months of 2023. Why? Because everybody believed we're going to have 6 to 7 interest rate cuts. Well, what's happened since then, of course, is the first interest rate cut they thought we were going to get was literally last week, and we didn't get it. And now that the economy had such a good December, it's very likely that there will be no interest rate cuts, even on the next meeting or even the meeting after that. And that means we should look at this. Let's look at the bonds. This is the 10-year note. We had that little spike up, but then the market got hammered and made a little new low. Here we are again below a long-term moving average on the 10-year note, which means, again, for those who don't know, as prices of bonds go down, that means the interest rates go up. So far, all the interest rate cuts that were built into the price of the S&P and the Dow and the NASDAQ over the last 3 months, not one single interest rate cut has occurred. And my guess is we won't see them, maybe, if at all, until June, which means now the market is just purely going on momentum. When I see something like this, where the long-term direction of interest rates is clearly from COVID here all the way moving lower, I don't feel this is a new low, folks, which means I think we could continue to move lower in price in the bonds. If this is the case, the interest rates market is still going to stay in this area, maybe a little higher on the long end. The mortgage rates are not really going to go down much more. They might stay here and actually bounce a little higher. And if that's the case, it will ultimately pull the wind out of the sails of the stock market. That being said, we are long stocks in almost all of our smartfolios, and we are long in a massive way. Long means we're in the market, which is what I think most people want to do when you open up a brokerage account and you self-direct your monies into either a smartfolio or stocks. So let's kind of go through them. Again, here's the Dow, the big advance, these new highs. We see that. We see the S&P also at new highs from here, from the old highs that were from 2021. NASDAQ, pretty much the same. It's a broken record, folks. But we should be noting, too, there's a problem. The Russell is not going along with it. And the reason the Russell isn't, that's the 2,000 stocks that represent the more of the smaller cap of the United States of America equity positions. In other words, the 2,000 smaller stocks. That has not made any new highs. Those highs occurred again way back in 2021. So something has happened. There is a disconnect. We've talked about this. It doesn't mean the market doesn't go higher, the broader market in terms of the S&P or NASDAQ, but this is concerning. That is concerning, and so are the bonds going lower in price, raising the yields. Here's something else that's also starting to make me more nervous: the dollar. If we look closely here, I'll bring it in. The dollar is getting stronger again. As the dollar gets stronger, that pulls away investment from offshore. In other words, it costs more money for people that live offshore to buy dollars. And once they own their dollars and translated their euros or their dinars or their Swiss francs or their British pounds into US dollars, they have less to buy stocks with. And the dollar has made a recent new high here. It has not achieved the prices it had before the huge rally. Now, if that occurs, if the dollar continues to get stronger, all bets are off, and we got to rely on the smartfolios and the AI to be able to manage these positions and get us out if the market starts to drop. Again, and let's now move. So we've looked at the Dow, the major indices. We've looked at the interest rates, which we see are kind of creeping higher by going lower in price. The dollar, which is also creeping higher by just going up. Those are things that are not good for the stock market. But here comes the Magnificent Seven. They will not give up the ghost yet. Here's Apple. It's not at a new high. Apple actually is struggling more than any other stock of the Magnificent Seven. Amazon has recently hit a new high. Look, we had the earnings. Their earnings came out. They did wonderful over Christmas. And voila, they posted an extra $10 a share, up 8%. So we're in this stock, folks. So we're participating here in the aggressive portfolio and even a little bit in the balanced portfolio. Google, came off of its highs because of their earnings were not as good, but they're still in an uptrend, and I wouldn't say that I would just sell this stock. It doesn't feel right. Here's Meta. Look at this. Another blowout earnings. Meta jumped literally $70 a share after their earnings. We're in that too if we're in our aggressive portfolio. Here's Microsoft. Can't kill this. Brand new highs. These just keep going higher every day. Let's round off, and for the sixth member of the Mag 7, here, new highs. These 7 stocks continue to lead the way. And this, if these all look good, take a look at this, folks, on NVIDIA. We're now almost 3 full standard deviations above a long average. Wow, is all I can say. I really rarely see things like this. And when you do, generally there's some reversion of the mean, but nobody walks in every morning these days and says, oh, let's sell NVIDIA. AI is the word, and the Magnificent Seven all have one thing in common. They are the forerunners of using machine learning to create artificial intelligence, something called unsupervised artificial intelligence, which is something that means it could become one day sentient, very similar to the movie I, Robot, where you could see these robots that actually started to think for themselves. Tesla is not part of the Mag 7, and it has been going down, but I think we all know the reason why there. And even though this is a great stock, a manager that does a very good job, at the end of the day, we saw all the problems with electrical cars. The idea that Hertz and Avis are going to be selling their fleets, I get it. And so this is an electric car move. I'm not really a big fan right now of owning electric cars until the fallout is done. This is Boeing. I won't go into any more because we'll get redundant. We know what's going on there. Anybody want to fly a 737 MAX? Anybody out there? No, not me. I'll wait till they fix the bolts. So I like the aisle seats, folks. Get wider leg room. But you also have a big window nowadays. It's possible. So I'm not interested in the window that gives me the front seat view of the world from 30,000 feet. Banking stocks, all in general, I'm not in love with them. If I look at Bank of America, it's hanging in there. It did make a new high, but it doesn't feel good. It's not like the banks are in trouble. They're just not responding well to me. Look at Goldman Sachs as an example. I mean, Goldman Sachs was $300 a share, and now it's almost doubled. It went up, $100 and some odd dollars a share for absolutely no reason since November, except for people thinking interest rates going down are now going to help the banks. It actually hurts the banks when rates go down. The energy market, we'll go to that real quick. Energy market, yes, we seem to be falling down, but that's because inflation is more under control. There's no doubt that inflation may be under control. However, the damage is done. The price changes to the upside are kind of now set in stone. It's going to take many, many years, if not a decade, to be able to unwind the cost hikes that have occurred at the grocery store and at the pump. It takes a long time. At the pump, it'll happen much faster. We've seen it go from $5 to basically $3 around the country. But groceries are not going to get cheaper. They are embedded an extra 20% higher. Um, Stocks I like, again, they remain these stocks that are the pipelines. Recently, we just had a new high, and one of my favorites, Energy Transfer. It came off. Of course, it came off. Why? It paid a dividend the other day. When you pay a dividend, the stocks kind of go down into them for the amount of the dividend. If you see the dividend's 31 cents, if you take the 31 cents here, you'll see, hey, you collect the dividend. This has been the nature of this all year, and these things march back up and make new highs. I'll quickly look at some of the cruise lines. Here we are. This is Carnival. We all know it. Hey, they're kind of hanging in there closer to their highs than they are their lows, which were back during the COVID. And that's true of most all of them. They're hanging in there. Whether they jump from here, I'm not so certain. We held those for a while, but they're no longer as interesting as they were a couple years ago. Finally, let's go to let's take a look at the foreign exchange markets, which I did look at. Mentioning the dollar is getting stronger. That is not generally a good thing for stocks. And why? If you just look, most of the dollar, this is the euro. The euro is getting weaker against the dollar here. Same thing is true of the British pound. It's kind of just hanging in its range, much lower than what I remember it in most of my life, which is where I lived for at least 3 years. I was able to get about $1.60 for my US dollars that I was paid in and translated into sterling. And so this is just the case. Let's look at the yen real quick. The dollar is, again, increasing against the yen. So that's why we see overall the dollar is stronger, and it's just not really sure exactly why, but we all know that it has a function of interest rates. Interest rates here are higher than they are in the rest of the world. That's one of the reasons why the dollar will still attract other currencies, because they can at least put it in our interest rate products. Finally, we'll go over to crypto. Let's make sure I'm not killing myself on time so I can ask some questions. It's always noteworthy to look at Bitcoin. So what I did here on the screen a while back is I'm looking at where would I buy this stuff on dips. So when we had that recent fall prior to our last AI circle, remember I might have showed you this chart. I picked a low back here in October to this high over here in early January, where we hit almost 50,000. And then we literally backed off. Here is a 382 retracement. I'm more of a science guy than I am a Fibonacci person, but it's always good to look at everything you can, especially with this kind of a market, which is it's traded by things like this. People look at these things and they look at it as, where do I buy? I couldn't see it exactly. However, I can tell you that we almost had a little 50% tracement off the high from the low back here, which was around 27,000 to about 49,000. We got all the way down right about there to about 38,000. So it came off about 12,000 points. And that's $12,000. And guess what? It's bounced right back. No information here to be able to say, no trading information I could surmise and offer as an opine to say, hey, the market's going higher or lower. But I can tell you, as I am a bull in this market, and I'm a bull in this market, again, only for its idea of a future currency that is beyond the banking system. It is not something that is a central reserve kind of digital currency, which I'm totally against. If our federal government wants to do that, all that does is allow our federal government to look deeper inside our finances. And I don't think the government is well-intentioned, just me personally, when they're looking at my own particular spending habits. It's not something I think any of us would relish. So we do not want that, but what we do want is a worldwide currency that nobody can look at. And okay, yes, it creates the issues of being able to use these things for nefarious reasons. For example, to buy drugs or to pay off debt or for crime. But that's the same thing as cash. And cash does the same thing. When people buy drugs, they're not using a credit card or a check. So when you buy things with cryptocurrency, the transaction is unknown except to the blockchain. So is that a good thing? Maybe not. But on the other hand, it still represents the privacy that I think we all want, whether you're an American who expects it or whether you're European that may have accepted something different because of the way their governments work, but they will still want privacy. Everybody does at some level, of course, except government. So let's finally go into what some of our portfolios look like. I think it's really kind of important to look at that. So for example, here's our conservative portfolio. I'll just have this here today to take a look at what's going on. So here's Amazon is one of the stocks that you own if you're in the conservative portfolio. And obviously that's doing well. Here is another one. It's been playing a range. And keep in mind, a conservative stock, this one, which is Enterprise Products, is paying a nice, powerful dividend. If you'll notice, it's 50 cents. So that's $2 on 26. And it stays in this range constantly. And of course, the reason we came down here again is partly because we just had the dividend. Energy Transfer, one of my favorites, same thing. Energy Transfer is paying over 9% at this price. And so we kind of like this stock. And it just came off of a high, a brand new high at 1460. Here's Hess Oil. Another thing, same thing. Look, the dividends all get paid right now. Here's the dividend, that little blue dot. So when the dividends come out, the stocks go down into the dividend. But look at where they're going in general. Goes up, goes into dividend, comes down. Over the next 3 months, it goes back up, pays the dividend, comes back down. But each time seems to be making new highs. Here, new high. Here's a new high, new high, new high. We're not long the spider, folks. Even though the spider is at a high, we would own this index, which is an important index, and this can represent 20% of a portfolio. It means that money would be in cash, but this would be bought, but we need to see a correction in this stock for this to be bought. Finally, and if it is, that would be great. I would love to see a 10% correction or even a 7% correction, in which case we can take a better entry point and manage our risk. Finally, before we get into questions, this is a good product. I don't know if a lot of people know what it is, but it is an AT&T bond that pays 5 3/4, almost like a CD. And look what it has done. We've owned this for quite a while, but it moves down, pays the dividend. It moved all the way down from last year from about 25 all the way down to 21.50. So that seems like, oh, it only lost $3.50. Well, that matters. But here we are back in where it belonged before all of this. And those of you that own it are still getting paid their 5 3/4% on the dividend. So this is thing that adds, because it's a conservative portfolio, we're looking for dividends. And here is the TLT. It's the bond, the 20-year government bond, which pays out right now somewhere in the area of about 4.4%. And it has also rallied up since last November with the expectation of lower interest rates. Again, it is a typical product that you would have in a conservative portfolio because it represents a 20-year government bond. If you look at all the products in there, you'll see that the overall dividend is around 6.5%, all things combined. So we're trying to get price appreciation at one level, but make sure we got a dividend at another. I like this portfolio still for those people that say, hey, I'm really not trusting the market that much. Our only exception to that rule is Amazon here. And we don't own a lot of it, but what little piece, this is a thing that kind of kicks the portfolio up and adds beta. And with adding the beta, because the rest of the things are so close, so unrelated to the overall market, it ends up adding a alpha kicker by increasing the beta. It's a math thing. It is something called the efficient frontier. That's a whole other conversation that one day perhaps we'll have, where I can explain to everyone what is the efficient frontier. And by the way, we do look at that. So there we go, Lee. I think that wraps up. We can go for some questions.
Yeah, along the lines of what you just said, and before I get to Andrea's question, one that I often get, and I know my answer to this, but I'd like to hear it from you. People ask about, what's the difference between, say, conservative and aggressive? Obviously, the risk, but talk about how you make a portfolio more aggressive or more conservative. You alluded to it already.
Yeah, I did. And so, all right, everybody, try to understand a very basic concept. We'll do it mathematically, and I'll keep the math simple. An aggressive portfolio is something that has a beta of 1. What is that? Well, the S&P 500, we use the spider around here because it's a proxy for that, has a beta of 1. In other words, that's the market. If you own stocks, like if you go to a wealth manager, like a Chuck Schwab or a Edward R. Jones, they put you in a bunch of stocks and they create a portfolio with you, depending on your desire, that has a beta. A beta that is aggressive is something that is above 1. A beta that is conservative is something that is below 1, the number 1. What is beta? The beta is the way a portfolio advances relative to the S&P 500. So if the S&P 500 goes up 1% and you have a aggressive portfolio of, say, that has a beta of 1.5, that means your portfolio should go up about 1.5%. In other words, it almost acts like leverage. So if I have a conservative portfolio and a beta of 0.6, that means that if the market goes up 1%, my conservative portfolio will only go up 0.6%. So right there, you can kind of see what the difference is between conservative, balanced, and aggressive. Balanced is a portfolio that has a beta of 1, give or take, say, 10%. In other words, from 0.9 to 1.1 would be a balanced portfolio. Anything above, say, 1.1 is an aggressive portfolio. Anything below 0.9 would be a conservative portfolio. Our betas, if you look closely at them, measured over literally a 90-day period, which I like the 90-day period because it's 1 quarter, are about 0.58 for the conservative, literally 1.02 for the balanced, and for the aggressive, it's 1.4. So those are things to consider. So if you're older and you're nervous about the market, you go into something like the conservative. If you're younger and you don't care because overall the market goes up, I would take the aggressive. If you're in the middle, you probably take the balanced. Just say, hey, I'm there. Remember, using artificial intelligence and machine learning is how we actually work to be able to manage that beta. So as the market goes down, because we only care about if it goes down, is to start getting out of our stocks so that we reduce the beta. That's the secret of wealth management, managing the beta of your portfolio.
Perfect. Well said. And just the layman's terms of all that, like you can make a portfolio more or less aggressive, obviously based on the components inside of it. So the conservative with those dividend paying stocks obviously aren't going to offer you the same high growth potential of something that might be in an aggressive portfolio, right?
I have to smile at the camera because I thought I gave the layman answer to the question.
No,
but go ahead, Lee.
No, you're right. You just
thought that
you were
was
talking all
layman
math.
to you.
No, your math, and I know it was layman's terms for you, but just for the person who knows nothing about math and beta and all that, you definitely learned a lot there, but it still might not make total sense to you. So again, Kelly's absolutely right. I'm maybe overly simplifying things. So let's get to Andrea's question. And Andrea, I hope I'm pronouncing your name correctly. She's asking about the different portfolios and how they're performing on the average. There's the question. So, like, I guess Kelly, let's start with like the SPY. As you said, there was a pretty good January. That's kind of our benchmark for a lot of portfolios. I think it's up somewhere around 3 or 4% so far this year, maybe slightly better than
Let's
that.
take a quick look. So
Sorry
we
to put
came
you on the
into
spot with
January
numbers.
24. Yeah, we're here at 45.78. We're into February. We're up about 200 points on that. So we're up already approximately 5% on the year. So that's where the stock market is. So if you just had the S&P 500 and that was the only thing you owned, you would be up 5% on the year. Our portfolios, you have to kind of look in. It all depends on when you bought them, right? If you bought your portfolio on the first of the year, the very first day of the year, or the very last day of 2023, you could look in your app and it would tell you where you are. In general, I can only speak in generalities, again, not knowing where people actually got into the market. But had you have been into the market, those things are really up around the amount of money that I've just told you based on the beta. So if you got in on the first of this year, your balanced portfolio would be up about 5%, but with a beta of 1.1, maybe 10% better than that. So about 5.5. Think like that, folks. So relatively exactly follow the beta. And all you have to do is just look into your app and you can see where they are. We're in the market. And if you look at your stock collections, you might see that actually some of our collections did even better than that. But again, I don't follow it completely on a day-to-day basis as I'm developing things for tomorrow,
Right.
and not looking at what's exactly going on today. But I do know the beta, and that's what matters to me.
Yeah. And Andrew, this isn't necessarily your question, but one that I get sometimes like not to say we don't care, but like in
Oh,
1 month, that's not necessary. That's not a long enough, time period. You might be ahead 5% or behind 5%, depending on if you're in cash. Like we're not really worried about a month, right, Kelly? We're more looking at a bigger picture.
yeah, remember everyone. It's very important to note we're not a trading company. We're not giving advice to people. We're showing people a product that allows them to self-direct their own account. So when you pick a smartfolio, you can look at how those smartfolios behaved in the past when you look at them and say, hey, they seem like they look like they performed well. Can't Past results don't mean anything about future results. Just like looking at the stock market in the past is not going to tell me what it's going to do tomorrow or this next month or 3 months. I can tell you though, over the next 10 years, if I see something that went up for 50 years, my bet would be over the next 10 years, it'll probably still go up. So Lee is right. You cannot look at any small a measure of time to be able to say, how is something doing? Here's another thing we can't do. Don't judge things by year to year, January 1st to December 31st. Here's what every investor I would admonish to do. When you invest in the market, write down where the S&P was when you invested. Where was the price of the S&P 500 index? Then you say, okay, I'm just a balanced person and I want to follow the market. You want to say, hey, my stocks that I picked inside of one of those smartfolios, the smartfolio I picked, has it gone up with the S&P 500, over a year's time? That's what you should look at.
Right.
Look at it like that. And then you got the right idea of how to invest. Because remember, we're trying to manage risk. And when you try to manage risk, there is a cost to that. The cost of that is some stocks will be in cash periodically. And when you put stocks in cash, what it's doing is it's actually reducing the volatility of your portfolio, right? Cash doesn't move up and down.
Right.
It just moves up and down with inflation. So cash is the hedge. And by the way, more cash you have, the less beta you have.
Right.
So,
And also Sorry, go ahead. You can finish.
No, I was finished.
Okay, I was just going to say to your point about writing down what the SPY is right now. If you were to get into the market, say tomorrow, and you track, okay, what did I do in 2024? The market's already made 5%. You're going to think you did 5% worse than the market. You just had different starting points, right? If you buy the SPY, which is your exact benchmark you're looking at, it's going to be the same performance if it's just a buy and hold. But my point is, in agreeing with Kelly, is that you have to look at where you started, not just the year to date or even the January 1st to December 31st numbers, because everyone's got a different starting point.
Right.
So good stuff. We maybe went into that maybe a little more than we were expecting.
Well, that's a
but
good
I think
one,
it's
though.
valid.
It's really a fundamental question. Is one of the things I've noticed is in the being part of Flip, because I've never really, when I look at in a way an investor looks at things, what I've seen a lot of is when you go to one of these shops and they'll say, let's get into the market. Nobody can time the market. So they'll say, let's buy the market right here. Let's buy it today. You went into Charles Schwab and you said, hey, I want to put my money into the market. And they give you bring you to an advisor. The advisor says, you can't time the market, so let's just buy. So they do, and they buy it right here, right where they're buying the high of today. And their bet is that they don't care what happens tomorrow. Their bet is that over the next year, 5 years, that you will make money if you bought it right here. And they'll give you all these beautiful pamphlets that show you that, hey, if you bought the high, the worst price you could buy at the very high, that if you just waited, X number of years, you would have made this much money. And they show you these wonderful little bar charts. That's great. When you look back on it for 5 years, you didn't experience the pain of that chart. You might have experienced a 30% loss right after you bought. And if you did, you wouldn't have been happy with your manager. And he would tell you, it's not my fault. The market went down. Hang in there, because in the next 5 years, the market will go up and you'll be making money. He's probably right. But what happens if the next 1 year or 2 years, the market goes down a lot more? You're going to feel less confident about what he said. Yeah. In other words, he's got no plan to manage your asset once he bought for you. So you endure all the pain, and all he endures is the tough phone call he has with you. That's a big difference. Much easier to endure the tough phone call than to be the person that's losing money.
Right.
So our product is trying to design to get out of that. Definitely. Because we don't want the tough phone call. What we want is to say, look, we're trying using a computer. When you pick a smartfolio, you're letting a computer try to find a better way to manage the ebbs and flows of the market. Here's an ebb, here's a flow. If we can do that better with a computer, then it should give you a smoother ride. Which means, yes, if the market goes up 20 and I make 15, yeah, I wish I made more. But if the market goes down 20 and I only lost, say, 10, you say, I'm glad I sidestepped losing. I could have lost 20% this year. And so what would you rather have? To be able to, if the market goes down and loses 20%, but you only lose 10, but the market goes up 20%, you only make 15. I like the one in the middle. Right. You're better off. Your net is still better off than your net if you did just buy and hold. Right. That's what we think.
Definitely. We've got a couple other questions piling in. Just as a reminder for everyone, how we do the Amazon gift card giveaway now. Kelly has been, I think I'll let him do it again tonight, is he's going to pick what he thinks is the best question that was asked, whether it's the most thought-provoking, just best question. It's totally up to him. But you have a chance to win the $25 Amazon gift card. All you have to do is just be an iFlip user and be invested into a Smartfolio. And then to claim this, all you need to do is email mailbag@iflipinvest.com or text this number here. And I will put these back up here in a minute once we announce a winner. We did get a couple other questions. Boris asked if we give monthly or quarterly reports. I'll answer this one. So when you, and I happen to know Boris is in the process of getting everything set up through his IRA Club account right now. So once you have money on the platform, you can actually see your performance every single day. Like I would argue you absolutely don't want to log into it every day, because you're going to be like, oh, I'm up 0.5%. Oh, I'm down 0.25%. You kind of paralyze yourself in a sense. But yeah, you'll not only get it monthly and quarterly on the platform, but you can really see it every single day if you want to. So,
and you do get monthly statements
it's true
from the clearing broker, and the monthly statements do show the performance and allocation, the usual things you would expect to see at any brokerage firm.
True. And then, I kind of think of the AI circle as like our report that we're doing a couple times a month as well, just to keep people informed.
Yeah, that is
Jim,
exactly one of the reasons why we do this.
yeah, and Jim was our winner last week. So welcome back, Jim. I know I said thanks for coming back in the chat, but it wasn't really a question, more of a comment. But I think it's really important. He said, my numbers have improved once I started using smart folios, much better at predicting than using my own emotions. Like, people might think this is a double-edged sword, but I tend to really like that the AI doesn't have an opinion or any emotions. Like, it's just doing what the math says is in my best interest to keep it dumb.
Can I comment on that real quick?
Please do.
Look, one of the things to Boris, I think is really important is in my career where I was placing trades all the time and I was around others that were doing exactly the same thing. Everybody, especially if you're at a bank desk or a manager's desk, a company that just invests money, like a fund manager. I try to not use the word hedge fund, but they are hedge funds. It's a big term, but it really just means a fund manager. Is that they all had a reason why they bought things or sold them short. They found some reason, whether it was fundamental or technical or both, most of the time both. They bought and sold things. And that means when they did that, they had a plan. They had a plan. There was no emotion for any of them. Yes, when they were losing and even when they were winning, they would have emotions. In other words, everybody likes to be right. Everybody likes to be right. The greatest thing in the world. You bought and you never experienced any pain. But what they all had in common was a plan. If you have a plan, you are able to sidestep some of your emotion because you have a plan. In other words, I've already said that if this happens, I'm going to do this. And if I make a profit, I'll take some off the table and reinvest later. Or if I lose money, I'll take my money out and I'll try to rebuy later. They all had a plan. Whatever method they used, there was a plan. And that means their emotions were confined. They were not eliminated, but they were not the same as a typical investor, which most of you are. And by the way, I am too. It's hard for me not to have some emotion when I'm right or when I'm wrong. But I can tell you that if you don't have a plan, everything goes deeply into emotion. And with you under a lot of emotion, you never can make a decision. That's why I've met some people in my life. They have recently lost, for example, a loved one. And the first thing I say to them is make no financial decisions at all, at least for a month or two. Make none. Because if you do, you could be making a mistake. So be very careful. When you're under emotions or stress, you are likely going to make an error. The idea of what Flip is and why I'm involved with it and why we have such great support from our clients and our backers is because they all agree with that one statement. Emotion has no place in business. And I think we would all agree with that. This is trading, investing. It's very emotional. It can be, but it really has no place here. We must be better than that.
Yep. And I would argue for 99% of people, it's impossible to detach your opinions and emotions from the trade. I'm sure every trader's had XYZ go exactly the way they thought, and they're like, oh, maybe it's going to do better. And so you go back on your own quote unquote rules as you were putting them, or plan. So, Jim, thank you for the comment. That it is nice to hear. Teresa, this is good. Thank you. You're welcome. Any last questions before we pick a winner? I'll give you guys a second. I
got to try to pick up the who won today, because let's see. Don't forget what my Flip monthly quarterly reports. My numbers have improved. What do you mean? How are the different portfolios? Oh, look, Andrea's question has to be the winners. Like, how are they performing? It's again, the answer to that is actually complex at some level. Again, depends. It's always individually based. But at the end of the day, knowing the performance of your product and what you're doing is the most important thing, whether it's on Flip or anywhere else. But it's knowing what it basically should be is the way I would like that question to be added or changed to make that a little better. You should always know where the S&P 500 is. And then you should say, okay, I know where that is when I invested. And I've also know that how much it's gone up or down since I invested at Flip or anywhere else. And then I just check, hey, how did I invest? Did I invest conservative? Then I should, if the market went up, you should make less because you're trying to take volatility out. So I want that question to be the winner tonight. Because I think generally that is on the right line.
Yeah.
For any product, no matter where you're at.
And I agree. And I think the whole point, you started by looking at the graph of the SPY or the chart and seeing how things have been going. Like, it has to be put up against, you have to measure your performance against something, or there's no point in looking at it, right? There's got to be a benchmark there. And
without
Jim,
a benchmark, what does it mean?
Right. Jim said, can you answer my first question? I'm not seeing another question.
I look for Jim's first question.
Feel free to send it in. I'm going to tell Andrea how she gets her winnings, and we'll still answer your question though. So Andrea, congratulations for being our winner tonight. Let me find it. So actually, I'll just put it on the screen here. So here are the two ways that you can claim this. And sorry, let me take the question down. Where did it go? There we go. Sorry, guys. So Andrea, either send us an email to mailbag@iflipinvest.com, or you can text this number as well. Just put your account number there, and if you have a screenshot just showing that you're in a Smartfolio, that will be plenty, and we will send you over your gift card. And then I think that's about it. And let's see if Jim got his question in. And also, on top of being the winner, Andrea, I'm glad you were able to to get something out of this information. This is awesome. Glad this is why we do it. I don't think Kelly or I do this just to hear ourselves talk.
Yeah. Well, sometimes I like to do that, but today I don't feel like doing that. I'm trying to recover from just something that hit me physically. It's just pretty painful. So I'm dealing with that. Jim, I can't see your question when I go through the chat backwards. I'm sorry, man. Send it over.
And Jim,
be the winner tonight, but we'll send it over if there's something I can answer, or Lee.
Jim, you can also just email us at mailbag@iflipinvest. It should be on the screen now. Just send us your question. For some reason, we didn't get it. I'm sorry about that. I know this chat was a little bit late to start going, so there might have been a handful of questions we didn't get to that never got to us. So if that did happen, feel free to send them into mailbag. I'll be sure to write them down and get them on our next AI Circle, which leads me to the next AI Circle is going to be on the 28th. I almost said the last day of February, but it's a leap year this year, so it's not the last one.
Election years are leap years.
Huh, never thought of it that way. Never put two and two together, I guess. Interesting. Well, awesome. Well, I think that's it for the night. Once again, Jim or anyone else who didn't get their question answered, sorry if we missed it. Send it on in to mailbag@iflipinvest.com. And I hope you guys have a great rest of your night, and we will be seeing you back here in a couple weeks.